Over recent years, investors have become accustomed to low interest rates, with central banks printing money and buying assets in an effort to support the global economy. Clearly this has been necessary, although these policies would always lead to periods of uncertainty when they have to be reversed. This has certainly been the case in 2015, as the key concern for investors was central bank action and the policy divergence between the Federal Reserve and the European Central Bank. On one hand, with the US Federal Reserve considering the possibility of tightening monetary policy and increasing interest rates, whereas on the other hand, the ECB were potentially easing monetary policy and lowering interest rates. This in turn has led to uncertainty within capital markets, and therefore one of the key themes in 2015 has been the increasing level of volatility in underlying government bond markets. So why hasn't the Fed increased interest rates in 2015? Well, despite improvement in the US economy, the Fed hasn't increased rates, with the reason for this being that the global economy is not in sync. In the first quarter of 2015, the European Central Bank's Governing Council implemented its quantitative easing policy in an attempt to combat the threat of deflation in the Eurozone. This helped drive government bond yields lower, and we saw a rush of corporate debt supply, particularly in euros, as companies took advantage of the low funding rates on offer to them. This high level of supply, combined with geopolitical concerns surrounding Greece and a potential exit from the Eurozone, led the second quarter to being a challenging period for corporate bonds, and we saw government bond yields rise over this period. One of the key themes in the second half of 2015 was the slowdown in the Chinese economy, which led to sharp falls in the Chinese equity markets. Concerns on how this would impact in the Far East and other emerging economies added to financial market volatility. Other knock-on effects of this slowdown has been a sharp fall in commodity prices, with the oil price falling from $70 to $40 over this period. All of these concerns weighed heavily on the Federal Reserve's decision-making process in September, and they delayed the first rate hike which we expected. The UK has been a relatively safe place to be, successfully navigating its way through a general election and delivering steady economic growth, although inflation does remain stubbornly low.
Corporate bonds have had a difficult year to date, continuing to be driven by macro factors which have led to an underperformance when compared to government bonds. The year started with promise as the ECB moved closer to and eventually announced their quantitative easing package, which sparked a global hunt for yield, causing spreads and yields to fall, leading to strong performance from corporate credit. However, as Kenny mentioned, geopolitical risks in Greece, Russia, Ukraine all started to emerge, and when coupled with concerns over Chinese growth and therefore global growth, corporate bonds began to retrace much of their earlier gains. Furthermore, as the Fed and the Bank of England move closer to the point at which they begin their respective monetary policy tightening, much of the uncertainty and volatility has found its way into credit markets. Despite the underperformance from corporate bonds, our funds have broadly mitigated this move through strong sector and credit selection. Financial bonds have outperformed the broader market over the period as spreads continue to compress, driven by higher levels of regulation, improved capital positioning and lower levels of leverage. We have and continue to favour this sector within the funds and have benefited accordingly. Within non-financial credit, much of the year has been dominated about what not to own, as well as the idiosyncratic risks and events. Whether it was commodity-related weakness, as Kenny mentioned, in names such as Glencore and Petrobras, re-leveraging M&A in cases such as Time Warner Cable, or even fraud and emission scandal that we've seen recently in Volkswagen. They've all had significant negative impacts to credit profiles and ultimately valuations. Over the year, through the use of our strong and robust processes, we've been able to avoid and therefore mitigate the impact of such events. Looking forward into the remainder of 2015 and 2016, we continue to believe that the Bank of England and the Federal Reserve will begin to tighten monetary policy and increase base rates. As such, we believe the risk is skewed to the downside in government bonds and remain underweight interest rate risk. Over the year, we've also maintained a constructive view on corporate credit and believe that the asset class still offers value and maintain a moderate pro-credit risk stance within the funds.